Two investors, the same rental property, the same rental income, and same costs. But one walks away with thousands more in cash in their pocket just because they chose the right ownership structure. See, owning rental property isn't just about location, it's about how you hold it. Get it right and you keep a lot more of your hard-earned profit. But get it wrong and you're handing thousands over the revenue that you do not need to. Think of it like plumbing. Build a house with bad pipes and you'll pay forever in leaks. Owning property is the same. So what's a smarter move? Owning property in your personal name or through a limited company? Hi, I'm Kevin Elliott and welcome back to the channel. I'm here to educate and empower you to make smart financial decisions, building and preserving wealth that lasts. Whether you're eyeing up your first rental, scaling a portfolio, or just planning for your family's future, this is for you. Hit that like button and subscribe for more Irish-focused personal finance insights. Today, we're diving into personal ownership versus company ownership. We'll cover taxes, capital gains, mortgages, extraction, legacy planning, and what fits your goals. So let's get started. Most Irish investors start by buying property in their own name, and it's easy to see why. There's no company set up, no extra admin, just you and the property. It's straightforward and flexible. So let's say you earn a salary of around €70,000 from your day job. Now, you buy a rental property, and after expenses, it brings in profit for around €5,000. Because the property is in your own name, the profit gets added to your regular income, so it becomes 70,000 plus the 5,000, so your total income becomes 75,000. So what happens next? That €5,000 is taxed just like your salary. In Ireland, once you cross a certain income threshold, currently €44,000, you move from the lower 20% income tax rate to the higher 40% income tax rate. So most of that rental income is taxed at 40% plus USC and PRSI. Altogether, your extra €5,000 will cost you about €2,000 in taxes. This means that you will keep around €3,000 of your profit into your pocket. That €3,000 is ready to spend, save, or reinvest. No delays, no extra paperwork. That is the key advantage of owning property personally: simplicity and direct access to the cash. It's a great place to start when your main focus is about cash flow and having control. But as your income grows or you add more properties, the setup may not be the most tax efficient. Hang with me. Shortly, we'll look at what happens when you buy a property through a company and how that structure changes everything. Now let's fast forward 15 years. You bought a property for $300,000 and you sell it for $450,000. That's a gain of €150,000. It's a typical sale. You'll pay 33% capital gains tax on the profit, so that'd be just under €50,000. So you'd walk away with around €100,000 in your pocket. Simple enough. But here's where personal ownership has a major hidden advantage. If you pass away while still owning that property, the capital gain essentially disappears. That's right, there is no capital gains tax due on the increase in value. Instead, if your child inherits the property at its current market value, $450,000 in this example, they may still need to pay inheritance tax, or capital acquisitions tax as it's called in Ireland. But here's the key. The first €400,000 inherited from a parent to a child is tax-free under what's called a Group A threshold. This means that only the €50,000 that is above the threshold is taxed at 33%, which works out about €16,500 your child would owe to revenue. Now compare that to the nearly €50,000 in capital gains tax if you had sold a property before passing on. That is a significant saving and much more tax-efficient way to transfer wealth to the next generation. So while inheritance tax cannot be avoided entirely, owning a property in your own name offers a clear advantage when it comes to legacy planning. It also helps ensure that more of your property's value stays in your family's hands. And this is a benefit that becomes even more important when we look at what happens a property that is owned through a company, because in that case, the outcome is very different. Now, let's look at buying a property through a limited company. Let's say the company earns €25,000 in rental income, and after expenses of $20,000, it's left with €5,000 in profit. The company will pay 25% corporation tax, so that'll be $1,250, leaving $3,750 inside the company. At first glance, that sounds like a real win. You've paid just 25% compared to the 40% effective tax rate in personal taxes. But here's the catch. That $3,750 isn't yours yet. If you want to take it out as a dividend and you're already earning, say, a salary of €70,000, that extra income brings your total to €73,750. Now you're taxed as if that was your total income, and you'll pay income tax, USC, and PRSI. Off the 5,000, you will only be left with 2,200 into your hand. That's a bit less than you would keep with personal ownership by around €1,000. So you might ask, why even bother with a company if taking money out costs you more? Well, the real advantage of a company isn't short-term cash, it's about long-term growth. Instead of pulling that $3,750 out, you could leave it in the company and reinvest it. But be mindful of this important rule: if you don't reinvest it within 18 months, you could face a 20% closed company surcharge, which would reduce your retained profits even further. So you need to plan. The real power of the company structure is not about cash in your pocket today. It's about building momentum, compounding returns, and turning retained profits into long-term wealth. As your portfolio grows, the difference between personal and company taxation begins to really matter. So let's say you own 3 rental properties, each bring in €5,000 in annual profit. That is $15,000 in total rental profit. If those properties are in your own name and you're already earning, say, €70,000 from your job, your total income rises to $85,000. Most of this rental income will be taxed at the higher marginal rate once you include your income tax, USC, and PRSI. This works out at about 48% effective tax rate on the €15,000 rental profit, or roughly $7,200 in tax, and you'll be left with $7,800 into your pocket. Now, let's look at the same scenario in a company. That €15,000 profit is taxed at 25% corporation tax, leaving $11,250 inside the company. That is over $3,000 more than you keep in your own name, and it's available for reinvestment. This is where the company structure really begins to show its strength. As your portfolio grows, so does your retained capital, and with it, your ability to scale faster, reinvest sooner, and compound returns over time. Okay, so let's take this even one step further. Now you own 5 rental properties, each one bringing in €5,000 in annual profit. That's a total of €25,000 in annual profits. Across the portfolio, you're earning €125,000 in rent and spending around €100,000 in expenses like mortgage interest, insurance, and maintenance. If you hold those properties in your own name, that €25,000 profit gets added to your existing income, and we'll go back to our €70,000 example, and your total income now becomes €95,000. Okay, so what happens now? At that level, most of the €25,000 profit is taxed at the higher marginal rates. Once you include again your income tax, USC, and PRSI. The effective tax on that rental income comes closer again to 48%. This means you pay around €12,000 in tax on the €25,000 profit, leaving you with just €13,000 in your pocket after tax. Now, let's compare that to owning the same property portfolio in a company. This time, the €25,000 profit is taxed at 25% corporation tax. That is $6,250, leaving €18,750 inside the company. That difference of €5,750 every year, well, that's where scale really begins to matter. Say over a 10-year period, retaining that every year could add up to $57,500. That is capital that you can use for a deposit, loan repayments, or to fund your next property acquisition without needing to draw it out personally and trigger even more tax. That is the true strength of a company structure. As your portfolio grows, so does your ability to reinvest profits tax efficiently. Less tax means more retained capital. More retained capital means faster growth over time. Mortgages play a major role in shaping your property strategy. When buying in your own name, many lenders still factor in your salary when deciding how much they will borrow to you. For someone earning €70,000, your personal borrowing capacity may be capped at around €300,000, around 4 times your income. That may give you enough to buy 1, maybe 2 properties. But once you reach that limit, growth becomes really hard, unless your income rises. But through a company, lenders take a different approach. They focus primarily on the property's rental income, not your salary as a basis for approving a loan. For example, if 3 properties bring in €45,000 a year in rental income and expenses are reasonable, that could support up to €600,000 in loans under a typical 1.25 times debt to service coverage ratio. It's not about income multiples anymore, it's about the number of properties that you have in the portfolio. That said, company mortgages often come with slightly higher interest rates. Traditionally, they could be at least 1% higher than your personal mortgage. Still, the big difference is this: there is no hard salary cap. With strong rental income and a solid structure, you can continue to finance more and more properties, 5, 10, etc. That's where company ownership really has an edge. Personal lending often restricts your scale, while company lending opens the door to long-term portfolio growth. There are two common mistakes that can affect property investors using a company, and here's how to avoid them. The first one is the 18-month rule. In Ireland, revenue applies a 20% closed company surcharge on investment income, like rental profits, that isn't distributed or reinvested within 18 months. So if you leave the profits sitting idle in the company, you could face an additional tax on top of your corporation tax. So this is why planning matters. To avoid the surcharge, either reinvest the profits or time your dividend payments strategically. The second mistake is trying to transfer property you already own into a company. Let's say you bought a property for $300,000. A year later, it's worth $400,000. If you were to transfer this same property into a company, revenue treats it as if you sold it at market value, even if no money changed hands. So this will trigger a capital gains tax of 33% on that artificial €100,000 gain, and you'll also face the legal fees, the stamp duty on the transfer, even though you still control the property through your own company. So instead of transferring existing properties, a more efficient approach is actually to keep them in your own name. Because remember, when you pass, your heirs will inherit them at current market value with no capital gains tax due. Use personal ownership for legacy and company ownership for growth. Withdrawing funds from a company requires careful planning to avoid unnecessary tax. One option is a director's loan. If you personally put money into the company, like funding a property deposit, you can repay yourself tax-free. It is a simple return of your original capital. You can also borrow funds from the company, but this does come with some conditions. If the loan isn't repaid within 12 months of the company's year end, the company may owe a 20% surcharge to the revenue. That this surcharge will only be refundable when the loan is repaid. And if the loan is interest-free, you could face a benefit in kind charge as a director. So short-term borrowings can work, but only if they're managed properly and repaid on time. Another tax-efficient strategy is to pay your spouse for legitimate work. Say it's handling tenant communications, doing the admin, or coordinating the maintenance. This works particularly well if they've got no income and you keep their earnings under €18,000 per year. In this scenario, they may not owe any income tax, and circumstances depending, they may or may not owe any PRSI or USC. Meanwhile, your company can deduct the pay to your spouse as a business expense, reducing your corporation tax. And if they earn above that threshold, their tax rate may still be lower than yours, especially compared to what you'd have received in dividends. Pensions, on the other hand, are more complicated. If your company only earns passive rental income, it won't qualify for tax relief on pension contributions. In fact, making pension payments could result in revenue disallowing the deduction and increasing your tax bill. How you own property shapes what happens when you pass it on, especially if legacy planning is important to you. With personal ownership, there is a clear advantage. If your property grows in value over the years and you so happen to pass away, the gain essentially escapes capital gains tax. Your heirs, like your children, they will inherit the property at its current market value. For tax purposes, it's a fresh start. They will pay capital acquisitions tax, which taxes 33%. But your children can apply the Group A threshold, which currently sits at €400,000. So the tax is paid when they receive the inheritance, not years later when they sell, and they will only pay it on anything above the Group A threshold. This means most of the property's value stays in your family's hands. With company ownership works quite differently, and it's more complex. Your heirs don't inherit the property itself. They inherit shares in the company that own the property. A capital acquisitions tax will still apply based on the value of those shares above the €400,000 Group A threshold, but the shares reflect the full company value, including any property or other assets and embedded tax liabilities. The property inside the company keeps its original purchase price, so if your heirs sell it, the company will pay capital gains tax on the entire gain from the date that you bought it. Then, if you want to extract the money as dividends, they will pay tax again at their personal income rates. So, while company ownership can be great for growth, personal ownership tends to work better for legacy. It's simpler, cleaner, and more tax efficient when passing wealth to the next generation. Your ownership choice depends on your plans. If you're buying 1 or 2 properties, personal ownership makes sense. It's easy to set up, no extra paperwork or cost. If you're looking to own 5 or more properties, well, consider a company structure. It really is the way to go. It keeps more profit in your hands early and less taxes up front. But a mixed approach can also work. Start with 1 or 2 properties in your own name for simplicity and legacy benefits. Then as you begin to scale at say 3 properties, switch to a company to scale up more efficiently, combining cash flow now with expansion later. Think about what you want, income today or a bigger future. It's your strategy and what matters for you that counts. Structure matters, so choose wisely. Because you're not just saving thousands, you're building a legacy that lasts. If you found this video helpful, please like it and subscribe for more Irish property and investing insights, and share it with someone who's ready to grow their money. So what's your next move, personal or company?